Welcome to our podcast, where we share our professional knowledge and experience for those considering commercial mortgages or loans. If you are in need of commercial mortgages or loans, contact us for a no-obligation free consultation. Let's start today's episode. Commercial Mortgages for Takeaways UK Guide. Commercial mortgages have become a popular financing option for business owners looking to purchase or refinance their takeaway shops in the UK. As a business owner, obtaining a commercial mortgage for your takeaway venture can not only provide financial stability, but also grant you a sense of ownership and control over your business property. Knowing more about the types of interest rates, repayment terms, and eligibility for commercial mortgages will help you better understand the process involved in securing a suitable financing option for your takeaway business. Understanding commercial mortgages. When looking to finance the purchase of a takeaway business, a commercial mortgage can be a suitable option. A commercial mortgage is a loan secured on a non-residential property, like a takeaway business, to help you purchase the property for your business operations. To obtain a commercial mortgage, you'll typically need to provide a deposit, which generally ranges from 20% to 40% of the property's value too. The more you can afford as a deposit, the better the mortgage terms you may be eligible for, resulting in lower interest rates and overall borrowing costs. Eligibility criteria for a commercial mortgage can vary depending on the lender, but some common factors they consider include your credit history, the financial performance of your business, and the potential for growth. Lenders want to ensure you have the ability to meet the repayments and keep your business running smoothly. So, it's crucial to present a comprehensive business proposal to demonstrate your financial strength and understanding of the takeaway market. The property itself serves as the primary security for the commercial mortgage for. This means that if you are unable to repay the loan, the lender has the right to repossess the property to recover their funds. It's essential to consider the implications of this and ensure you have a solid financial plan in place to support your commercial mortgage repayments. Navigating the process of obtaining a commercial mortgage for your takeaway business can be complex, but understanding the key aspects, such as deposit requirements, eligibility criteria, and the security implications, will help you make informed decisions and secure the optimal mortgage for your business needs. Types of interest rates. When considering a commercial mortgage for a takeaway business in the UK, it's essential to understand the different types of interest rates available. There are two primary types of interest rates, fixed and variable. Fixed interest rate. A fixed interest rate offers the benefit of stability and predictability. With this type of interest rate, your monthly mortgage payments remain the same throughout the entire term of the loan. This allows you to effectively plan your budget and avoid any unexpected increases in your repayments. Lenders typically offer fixed-rate commercial mortgages for terms ranging from 1 to 25 years. Depending on your individual circumstances. One key advantage of a fixed interest rate is that you're protected from any potential interest rate increases, which can lead to significant savings in the long term. However, if interest rates were to decrease, you may end up paying more than you would have with a variable rate mortgage. Variable interest rate. A variable interest rate, on the other hand, can change over the term of the mortgage. This means that your monthly mortgage payments fluctuate based on the movements of the interest rate. There are two common types of variable interest rates, tracker rates and standard variable rates, SVR. Tracker rates are directly linked to an external reference rate, such as the Bank of England base rate. This means that your interest rate will move in line with this reference rate, which can result in either higher or lower mortgage payments. Standard variable rate mortgages, also known as SVRs, are determined by the lender and can change at their discretion. Although these rates are often influenced by external factors such as the Bank of England base rate, they are not directly linked. In conclusion, choosing between a fixed or variable interest rate is a crucial decision when obtaining a commercial mortgage for a takeaway business. Each option has its pros and cons, and it's essential to weigh these against your business's financial needs and your risk tolerance. Ultimately, the choice will depend on your preferences, circumstances, and future projections for interest rates in the UK. The process of financing takeaways. When exploring the world of commercial mortgages for takeaways, it's essential to understand the financing process. As a business owner, you'll benefit from a clear and concise understanding of what it takes to secure this type of funding for your endeavor. Let's dive into the process, covering elements of finance, accessibility, and the application process. To begin, you must evaluate your financial situation to ensure you can confidently approach lenders. Determine your available funds, such as savings or existing investments, and assess how much you need to borrow to establish your takeaway business. Knowing your financial position will provide a solid foundation for your application. Next on the agenda is researching potential lenders and their accessibility. Lenders for commercial mortgages vary, from mainstream banks to specialized brokers, each with their unique lending criteria. It's crucial to compare their offerings and terms, so you can choose the best option for your specific circumstance. Don't be afraid to negotiate or ask for more favorable terms while discussing your needs with a lender. After identifying a suitable lender and understanding their requirements, it's time to prepare your application. The application process consists of gathering necessary documentation, such as business plans, cash flow projections, and personal financial statements. Having these documents organized and readily available will demonstrate your commitment and credibility to lenders, increasing your likelihood of approval. In conclusion, securing a commercial mortgage for your takeaway business requires careful financial evaluation, researching potential lenders, and submitting a well-prepared application. By following these steps, you can confidently navigate the financing process and set the foundation for your venture's success. Stay persistent and focused, and you'll be on your way to establishing your dream takeaway business. Role of mortgage brokers. When it comes to securing a commercial mortgage for a takeaway business, working with a knowledgeable and experienced mortgage broker can be beneficial. Mortgage brokers, particularly those registered with the NACFB, can guide you through the complex process of obtaining a commercial mortgage and provide valuable insights into the market. Mortgage brokers have access to a wide range of lenders, and they ensure you receive the best mortgage options available for your takeaway business. By using their expertise, they can assess your application, provide advice on suitable lenders, and even negotiate better terms on your behalf. This can save you time and effort, while also helping to reduce the risk of making costly mistakes. Moreover, a commercial mortgage broker can offer tailored mortgage solutions without additional charges, making it even more cost-effective for you to secure financing for your takeaway business. They can help to navigate the various high-volume commercial mortgage products available and identify the most favorable deals. In addition to their industry knowledge and expertise, mortgage brokers can also help you effectively communicate your business plan and financial standing to potential lenders. This is especially important when securing a commercial mortgage, as lenders often require a strong and persuasive application to consider granting a loan. In conclusion, working with a mortgage broker for your takeaway business's commercial mortgage needs can prove to be a wise decision. Their expertise, network, and guidance will help you find the most suitable financing solution for your business, ensuring you can focus on building a successful takeaway venture. Repayment terms and conditions. When applying for a commercial mortgage for your takeaway business, it's essential to understand the repayment terms and conditions. These will vary depending on the lender, but there are some common aspects you should be aware of. Firstly, repayment terms for commercial mortgages generally range from 5 to 30 years. This gives you plenty of flexibility to decide on a term that suits your business's cash flow and long-term plans. It's crucial to choose a term in which you can comfortably make the monthly repayments without putting undue strain on your business. Interest rates for commercial mortgages can be either fixed or variable. With a fixed interest rate, you'll know exactly how much you'll be paying each month for the entire term, making it easier to budget and plan. On the other hand, variable interest rates may provide lower initial payments, but they are subject to fluctuations, as they are typically linked to the Bank of England base rate. Lenders may also offer capital repayment holidays, allowing you to temporarily halt payments if your business experiences financial difficulties. However, these repayment holidays are subject to approval and may affect the overall cost of your mortgage. Some commercial mortgages don't have early repayment charges, meaning you won't be penalized if you decide to pay off your loan ahead of schedule. Nevertheless, it's vital to check with your lender, as early repayment charges could significantly impact your bottom line if they apply to your mortgage. Additionally, don't forget that a commercial mortgage is typically secured against your business premises, which means your property is at risk if you fail to keep up with repayments. Make sure to carefully assess your business's financial stability before committing to a mortgage agreement. In summary, familiarizing yourself with the repayment terms and conditions of your commercial mortgage is a vital step in securing financing for your takeaway business. By understanding the various factors involved, such as repayment term lengths, interest rates, capital repayment holidays, and early repayment charges, you'll be well equipped to make informed decisions and ensure your mortgage aligns with your business's needs and financial objectives. Eligibility and application. When considering a commercial mortgage for your takeaway business in the UK, it's essential to understand the eligibility criteria and application process involved. Being confident and knowledgeable about these aspects will make the journey smoother and increase the likelihood of securing the mortgage you require. To be eligible for a commercial mortgage, you must be over 18 years old and meet specific criteria set by the lender. Eligibility criteria typically focus on your financial track record, the strength of your investment history, and the value of the property you wish to purchase. Lenders will also assess the viability of your takeaway business and its potential for generating sufficient income to cover the mortgage repayments. The application process for a commercial mortgage can be complex, but having a clear understanding of the required steps will help you navigate it more effectively. Firstly, you'll need to gather all relevant documentation, including your business plan, financial statements, and evidence of your income and assets. You may also need to provide details of the tenant and a copy of the lease if you plan to rent the property to another business. Once your documents are prepared, you can approach a mortgage broker or visit a lender directly. It's essential to research multiple lenders, as each may have different eligibility criteria, rates, and terms. Compare the offers to find the most suitable option for your needs. Keep in mind that your application is subject to status, meaning approval depends on your ability to meet the lender's criteria. After submitting your application, the lender will carry out credit checks and assess your documentation to determine whether you meet their requirements. Providing accurate and complete information will increase the chances of your application being accepted. If the lender approves your application, they will issue a formal mortgage offer, and you can proceed with the legal process to finalize the purchase of the property for your takeaway business. In summary, to apply for a commercial mortgage for your takeaway business, ensure you meet the eligibility criteria, gather all necessary documents, research multiple lenders, and present a strong case for your application. By following these steps and maintaining a confident, knowledgeable, and clear approach, you can increase your chances of securing the mortgage you need for your business venture. Benefits of commercial mortgages for takeaways. A commercial mortgage offers several advantages for takeaway owners like you. One significant benefit is financial flexibility, as it allows you to spread the cost of owning the property over an extended period. This financial independence can create a more stable business environment, enabling you to focus on growth and expansion. Purchasing your takeaway premises through a commercial mortgage can lead to long-term capital appreciation. As the property's value increases over time, your investment will potentially grow, benefiting your overall wealth and business equity. Ownership is another key advantage, giving you control over the property and enabling you to make modifications without seeking permission from a landlord. This flexibility allows you to adapt your business as needed, catering to changing customer demands and making improvements to boost your takeaway's profitability and success. Securing a commercial mortgage can also help you save money on rent. While rent payments may be lower in the short term, they can increase over time and subject you to the landlord's decisions. In contrast, a commercial mortgage usually offers fixed or capped rates, making your monthly payments predictable and potentially more affordable in the long run. Finally, a commercial mortgage may offer tax benefits for your takeaway business. In many cases, the interest you pay on your mortgage can be tax-deductible, potentially lowering your overall tax bill. In summary, a commercial mortgage can provide your takeaway business with numerous benefits, including financial flexibility, the potential for capital appreciation, increased control over your premises, predictable monthly payments, and potential tax advantages. What is the typical deposit required for a takeaway commercial mortgage? The deposit required for a takeaway commercial mortgage usually ranges from 10% to 30% of the property's value, depending on various factors, such as your credit history and the lender's policy's source. You'll need to plan your finances accordingly and ensure you have a sufficient deposit ready when applying for a commercial mortgage on a takeaway. How do lenders assess eligibility for a commercial mortgage on takeaways? Lenders assess eligibility for commercial mortgages on takeaways using various criteria, including your credit history, trading history, income, business plan, and the property's location and condition. They will also evaluate the local demand for takeaways and the potential profitability of your business source. It's crucial to prepare a strong business plan and to maintain a good credit score to improve your chances of approval. Which institutions offer commercial mortgages for takeaways in the UK? Various financial institutions in the UK offer commercial mortgages for takeaways, including high street banks, building societies, and specialist lenders. As commercial mortgages are often tailored to individual circumstances, it's essential to research and compare different lenders to find the best fit for your specific needs source. What factors affect the interest rates for commercial mortgages on takeaways? Interest rates for commercial mortgages on takeaways are influenced by several factors, such as the property's location, your credit history, the loan-to-value (LTV) ratio, and market conditions. Additionally, variable interest rates can fluctuate over time, affecting your budget and long-term cost source. To obtain the best possible rates, maintain a strong credit history and be prepared to provide a substantial deposit. How long does the application process take for a UK commercial mortgage for a takeaway? The application process for a UK commercial mortgage for a takeaway can vary, with typical timeframes ranging from a few weeks to a few months, depending on the complexity of the transaction, the lender's criteria, and property-related factors source. You should allow for a reasonable timeline for the application process and work closely with your lender and solicitor to ensure a timely and smooth process. Can a new business owner apply for a commercial mortgage for a takeaway? Yes, a new business owner can apply for a commercial mortgage for a takeaway. However, you may face additional challenges in securing finance due to a lack of trading history. Lenders will often require a comprehensive business plan, personal guarantees, and a strong track record in the food industry to assess your application source. It's essential to demonstrate your experience and expertise in the takeaway sector to increase your chances of being approved for a commercial mortgage. For more information, you can contact us by clicking the link in the description of this video. Thank you for listening to our podcast. We look forward to coming together again in the next episode to share more information and experience with you. For now, goodbye.